Welcome to CoreLogic's update on housing market conditions for June 2017. CoreLogic's May results provided further support that the pace of capital gains is losing some momentum, particularly in Sydney and Melbourne, where housing market conditions have been the hottest. According to CoreLogic's Home Value Index, capital city dwelling values slipped 1.1% lower in May, which was the largest month-on-month decline in 18 months. It's important to note that May has historically been a seasonally weak month of the year. Adjusting for this seasonality suggests that capital city dwelling values were flat rather than falling in May. However, there has been some noticeable easing in the trend rate of growth, as well as other indicators such as auction clearance rates, transaction volumes, housing finance, and consumer sentiment all slowing down. The slowdown in housing market conditions has been more noticeable across the unit sector rather than detached housing. The first 5 months of 2017 have seen capital city house values increase by 2.8%, while unit values have remained virtually flat with a 0.2% rise in values. The stronger performance of the detached housing sector likely reflects the growth in underlying land values, as well as higher supply levels weighing down on the growth rates in the unit market. Auction clearance rates, which provide one of the timeliest indicators on the fit between buyer and seller expectations, have been moderating since mid-April, reaching 72% in Sydney over the first week of June and 73% in Melbourne. Both results were the lowest clearance rates over 2017 to date, and preliminary results for the second week of June show some further slippage. While these figures still indicate an overwhelming majority of auctions are successful, the clearance rate is on a clear downwards trend. The number of settled sales has also trended lower, which is likely attributable to a range of factors including tighter credit policies, affordability constraints in some markets, low advertised stock levels and weaker sentiment. CoreLogic estimates that national settled sales are 4.6% lower year on year, with substantial falls recorded across Melbourne, Brisbane and Sydney. On the other hand, some markets which have been weaker have seen transactions holding firm or rising. Year-on-year settled sales moved off a low base in Darwin, rising 2.6%, and Perth sales edged 0.3% higher. Adding to the complexity in reading the current market is the recent Australian Prudential Regulation Authority announcement at the end of March for a new round of macroprudential measures aimed at slowing the pace of interest-only lending. Based on the new rules from APRA, Australian lenders will need to reduce lending on interest-only terms to less than 30% of new originations. Considering interest-only loans currently comprise about 36% of new mortgage lending, there's likely to be some further slowdown in loans originated on interest-only repayment terms. Subsequently, mortgage rates are continuing to trend higher, particularly for investors and interest-only loans. Another factor that's likely contributing to slower growth conditions is a dent in consumer confidence. Consumer sentiment towards housing, as measured by Westpac and the Melbourne Institute, showed a marked downturn in May. In particular, the Westpac Time to Buy a Dwelling Index fell 6.5% over the month. According to Westpac, consumer sentiment towards housing shows an increasingly negative view. The Perth housing market saw dwelling values fall a further 0.4% in May to be 3.8% lower over the past 12 months. Since peaking in December 2014, Perth dwelling values are now down 10.3%. While the growth rate remains negative, the Perth housing market is showing some tentative signs of levelling, with settled sales inching higher over the year and listing numbers starting to reduce and a moderation in the downwards trend in home values. Overall, the negative May index results from CoreLogic comes at a time of seasonal weakness, which may imply that calling a peak in the housing market is premature. But it's becoming increasingly clear that some of the heat has left the Sydney marketplace and to a lesser extent Melbourne's. One of the key factors affecting housing market conditions is likely to be the fact that mortgage rates are now pushing higher. Since August last year, discounted variable rates have risen by 10 basis points for owner-occupiers and by 35 basis points for investors. Mortgage rates could rise further as the recently announced macroprudential measures from APRA progressively impact on credit policies and the federal government banking levy comes into effect on July 1st. Small rises in mortgage rates are likely to have some impact on housing demand, considering household debt is tracking at record highs. For investors, the higher cost of servicing their debt comes at a time when rental yields are close to record lows in Sydney and Melbourne, which are also the two cities with the largest concentration of investors. Landlords are likely to try pushing rents higher But this may be difficult considering the weak wages growth environment and the fact that rental supply is high in some regions. While we are expecting investment activity to slow, the fact is other asset classes aren't likely to be as attractive as property to investors. Cash and bonds continue to provide low but safe returns, and equities remain volatile. Considering the alternatives, we're likely to see property investment remain a popular option. If investors are concerned about the run of capital gains in the two largest capital cities coming to an end, more astute investors may start changing their focus towards the rental market return, given the possibility of lower capital growth potential. Yields are much healthier in cities like Hobart, Brisbane and Canberra, and the growth cycle is nowhere near as mature as what it is in Sydney and Melbourne. In summary, the jury's still out on whether the housing market has peaked. However, if it hasn't, a peak could be just around the corner. The housing market remains as diverse as ever, and the flow of data over the coming months will be a critical factor to get a better understanding of the trends. Of course, you can stay in tune with regular housing market updates via the CoreLogic website at www.corelogic.com.au.